Hello and welcome back to our fourth lecture video dealing with Chapter 9, still talking about long-lived assets. But in this video, we're kind of going to switch gears, right? We've talked a lot about plant assets. We know what plant assets are. We know how to record them. We know how to get them off our books. Now we're going to switch gears and we're going to talk about another long-lived assets, which are intangible assets. So, hopefully, by the time we finish this video, you'll have a better understanding of the nature of intangible assets, as well as how we account for intangible assets. So when we're looking at intangible assets, remember from the beginning, we defined intangible assets as assets that benefit the company, right? But they don't have any physical substance, okay? So we're going to look at a number of resources that a company could have that do not have any physical substance, but the company benefits from them, okay? So when we're talking about intangible assets, we acquire these from outside firms, right? And we record them at their acquisition costs. So intangible assets, when we're talking about the recording process, it's very similar to plant assets, meaning we have to record them at the acquisition cost and we have to allocate their expense over their useful life or over their expected life, okay? The only difference is when we're talking about plant assets, we talk about depreciation. However, when we talk about intangible assets, we talk about amortized. So we're going to amortize these assets. So if we have to decrease their value in any way, or decrease their value, we are going to not depreciate them, we are going to amortize them, okay? Now, we'll go through the journal entry on how to amortize intangible assets, but we don't have an accumulated amortization expense like we do with depreciation, right? When we have to depreciate a plant asset, remember we debit depreciation expense, and then we credit our accumulated depreciation, okay? We do not really do that with intangible assets, right? There is going to be an amortization expense. However, the credit is actually going to go straight to that intangible asset, okay? So it differs from how we depreciate a plant asset. Remember, plant assets, we use accumulated depreciation. We never touch that plant asset's cost. We always have it on the books at the acquisition cost. Intangible assets, on the other hand, says, you know what? We're going to, whenever we have an amortization expense, we're going to take that credit, we're going to go straight to that intangible asset. So we have a number of intangible assets, okay? These are pretty important to know what they are and how long they're expected, what are their expected lives, okay? Let's look at goodwill. Goodwill is the amount that a company pays for another company above its identifiable net assets, okay? What in the world does that mean? Well, let's think about it. Let's say we're going to buy a local restaurant, okay? And that local restaurant that we're going to buy has net assets, right? Remember what net assets are. It's the difference between assets and liabilities, right? That's our net assets. So we look at those net assets and we say, okay, the net assets are $100,000, right? So that's the price of that restaurant technically is $100,000. But the restaurant owner says, you know what? I have an established clientele. I've been here for 50 years. I'm a well-established business. I don't want $100,000, which my net assets are worth. I want $200,000. So we say, okay, well, we agree to that. So the goodwill is that $100,000 that we pay above the net assets of that acquired company, okay? Trademarks, right? We talked about this a little earlier. Remember, we used the example of the Nike swoosh, right? And trademarks are the right to use certain terms, names, or symbols, okay? Franchises. Franchises are an exclusive right to operate or sell a specific brand of product in a specific area. Let me give you an example. My wife's cousin, her family owns a lawnmower shop, right? It's out in the country, so they sell, they fix lawnmowers and tractors and things like that, and they sell, parts for farm equipment. But in addition to that, they have a franchise deal with Steel, the Steel company. They make weed whackers and chainsaws and things like that. So they have a franchise with Steel. So basically that means that they are the exclusive dealer to sell Steel brand products within a specific area. Next, we have copyrights. Okay, we mentioned copyrights before. Copyrights have a really long life, right? When we're looking at copyrights, remember these are protections against what they call intellectual property, right? So if somebody writes a novel or somebody writes music or records music or makes some sort of art, right? That's what a copyright does. A copyright protects that owner against somebody else releasing that or trying to make a profit off that image or that sound or those words, okay? So the life of a copyright is the life of the author plus 70 years, okay? Looking at patents. A patent is an exclusive right or privilege that is granted to an investor. Now, patents only last for 20 years. Once that 20 years is up, guess what? Anybody can make that product and try and sell it, okay? So looking at corporate social responsibility, being a Chatham, we're really big on social issues and being socially responsible, especially being responsible when it comes to the environment and things like that. But we're looking at corporate social responsibility, right? Corporations have a duty really to protect the environment, right? They have a duty to invest in business practices that hopefully cut down on carbon footprints, cut down on pollution that they put into the air. We can argue all day till the cows come home. Maybe they're not, maybe the EPA and the government and all the regulations aren't stringent enough. But again, at the end of the day, I think it's up to the companies and the corporations to recognize that we do have a responsibility, to the earth and to the stakeholders in the cities and the towns and whatnot that we operate in. So when a company actually goes out and they say, okay, you know what, we're going to embody this idea of corporate social responsibility, especially when it comes to the environment and protecting the environment. There's a lot of benefits for companies in doing that. Number one, it improves their brand image, right? Think about it. I think I might have mentioned this in this class too. I'm not sure. We as consumers, we vote with our dollars, right? And if a business isn't investing in practices that prevent pollution or reduce pollution, we don't have to shop there. We don't have to buy their products, right? And I think that helps. That helps the companies. It improves their brand image. They avoid having the government involved, right? If they're going to do it themselves and they're going to cut down on the pollution, then there's going to be less government intervention. They're going to hopefully avoid any future regulations. And there is some cost savings involved with reducing waste, disposal, and cleanup. Okay, so what I want to do real quick is just jump into the balance sheet, right? We talked an awful lot about how to record plan assets and depreciation, how to record and amortize intangible assets, but what do they look like on our balance sheet? And that's pretty important because I know a lot of you guys are going to, going for business degrees, getting MBAs. I got to be honest with you, this debit and credit crap, you got to know it to get through the class. But the most important thing that I believe I think will be very beneficial for you guys is, you might not need the nuts and the bolts of putting together a balance sheet, but you got to know what it looks like. You got to know the concepts behind the balance sheet, right? That will give you the most value. Once you understand how to put these things together, then we can take it a step further and actually analyze those balance sheets and look at them and, hopefully make good decisions based on this financial information. So what we have here is a classified balance sheet, right? Nothing new. We only have the asset section, obviously, because all we see are assets. But notice what we have here. We have our current assets listed, and then we total out our total current assets, and then we have our PP&E, right? We report it net, so we don't list out every individual asset that we have. So we're using Tesla Motor Company, right? How many assets do you think, plant assets, equipment, property, all that good stuff, that Tesla owns? Probably a boatload, right? Literally. Their balance sheet would, if they listed every single plant asset that they have, their balance sheet would go on forever, right? So what we do is we condense all that information and we just have one line and said, hey, here's our property, plant, and equipment net, and that means net of accumulated depreciation. So when we look at this, we don't know what their acquisition costs are for each asset. We don't know what their accumulated depreciation is for each asset. What we do know, however, is what their book value is in total of all their plant assets. Okay. Then we have other non-current assets. We're going to lump all the intangibles that we talked about in there. Again, think about Tesla, right? I'm sure they have, I don't know how many, but I'm sure they have a lot of patents, right? Copyrights, things like that, trademarks. So we're not going to list all of them. We're just going to lump them in and say, you know what, these are all the other non-current assets. Okay. We didn't get into the liabilities here because obviously this chapter really doesn't talk about liabilities. We'll look at that in our next chapter. Real quick, very important numbers that we need or ratios that we need to look at. Return on asset ratio and the asset turnover ratio. So these are really, really important. And if you get into any advanced, I don't want to say advanced, if you get into any like corporate finance, you'll talk about return on assets. So it's very important that you know how to calculate it and exactly what is return on assets. So when we look at assets, we want to analyze those, right? We want to know how efficient does the firm use their assets, right? How effectively is the company managing their operations? And that's one thing that we gain when we look at assets and analyze them. So the return on, or the rate of return on a company's assets is what we use, or what analysis use to really measure how well the overall the company's doing. How healthy are they, right? How do we calculate return on assets? Super simple. We take our net income and we divide it by our average total assets. Now, how do we get average total assets? Very simple. Normally we'll have a comparative balance sheet and we take the value of the assets at the beginning of the period plus the assets, or the value of the assets at the end of the period. Add those two up, divide by 2. That's our average total assets. Super simple. Okay. The next thing we have is asset turnover. Okay. So when we're looking at asset turnover, Here we're looking at how effective is the firm at using their assets to generate sales. Okay, so this is how effective is the company, right? How efficient is it? So asset turnover is nothing more than net sales divided by average total assets. Same exact equation, basically. The only difference is when we look at return on assets, we're saying, okay, let's look at the net income. Sales, we're saying, asset turnover, we're looking at sales. So how effective is the company at using its assets? Net sales divided by total average assets. If we want to know how efficient the company is, we look at net income divided by average total assets. Okay? So that's the end of the chapter, thank goodness. We're going to jump into our demo videos. I am cutting down the homework for you guys. I realized that when I was planning, I was way too overzealous. I apologize about that. So we'll cut those down. I'll go over the problems that you need to do for homework, and I'll do the corresponding B problems. Okay? So thanks for tuning in, and we'll see you in the demo section.